A very good evening to one and all. I'm sure it's the tax season, and there are many people who would want to hear straight from our expert from Clear Tax. Her name is Megha Jain. So my name is Steffi. I forgot to inform about my name. My name is Steffi. I am here to host the webinar along with Megha. So Megha is an experienced income tax specialist who has nearly a decade of expertise in direct taxes and much more, which is known as personal taxation. She has a lot of experience with Big Four firms, and she has built a strong foundation in tax compliance, advisory, and planning. And I'm sure this is a tax season. Many of us want to know what is income tax returns, who are new, who have newly started their jobs. Many people who are already doing their job for a years together, they must be wanting, whether new tax regime is great or old tax regime is great, or which is the form I need to fill. And I'm sure there are multiple questions in our head right now. So I won't take much of your time here. I have Megha on the other end, who will walk us through in detail the entire ITR filing process we have for this year. So stay tuned. In case you have any questions, there is a Q&A section there. You can drop those questions there. Megha would take it towards the end of the session. Over to you, Megha.
Thank you. Thank you so much, Steffi, and a very warm welcome to all our audience members here. I see that we have close to about 740 participants with here today. So before we begin the session, there is just one thing that I wanted to check with a lot of our audience members here. So I have just started a poll. How many of you all here attending the session today have filed your income tax returns or are on the process or in the process of going ahead and preparing your computation and filing the ITR? All right. So currently close to about 80% of the audience has not filed their ITR yet. All right. So this is going to be a very enlightening session. I hope to all the participants here. I have another question. All right. So while those of you who have not filed your ITR, are you aware of the key changes made to the ITR forms this year? So there have been several reforms post last year's budget. And as a direct impact of those reforms, there have been significant changes in the ITR. In fact, one of the main reasons for going ahead and extending this due date for filing the ITR from 31st July to 15 September is because of these changes in the ITR form. And these changes took quite a while to be published on the IT portal also. All right. So here again, a good chunk of the audience, close to 90% of the audience members are not really aware of the key changes that have been made to the ITR forms. All right. So I am very confident and hopeful that this session will be very, very helpful for you to go ahead and understand what are the changes made and what will it have, what is the impact it will have on you and your ITR filing for the current assessment year, which is assessment year 25-26. Before we move on to the main agenda of the webinar, one last question that I have to ask all my audience members. Are you aware of, the claim procedure for this year? ITD is making claim deduction fully transparent. So whether you're claiming any exemption or deduction, whether it is HRA, whether it is ATC, ATD, or leave encashment, anything, any and every claim that you make, it comes with full transparency. All right. So here again, close to about 80% of the audience members would require more clarity. They are not really aware of what is the procedure to make all the claims. So again, I'm very hopeful and confident that, by the end of this session, a lot of these queries will be answered, whether it is in terms of ITR forms, all the deductions, and also how to go ahead and file your taxes DIY using the Clear Tax platform. So we will also go ahead and give you a walkthrough on how to use the platform. So without much ado, let us go ahead and begin the session. So as discussed, the agenda for today's session is to first understand what are the key documentation required for ITR filing, what are the additional compliance requirements for taxpayers opting for the old tax regime, ITR forms for assessment year 25-26, key changes in these ITR forms for assessment year 25-26, and what are the key points or what are the important points one needs to keep in mind with respect to assessment year 25-26 filing. And once we have discussed all these key changes, important changes, then we will go ahead and give you a walkthrough of filing your ITR using the ClearTax platform. First and foremost, let us understand what are the key documents required for ITR filing, irrespective of the regime that you're opting for, whether you're opting for the old tax regime or the new tax regime. First and foremost, if you're a salaried employee, you will require Form 16. You will require both Part A and Part B. And in some cases where you have to give a detailed breakdown of your salary structure, you will also require an extra to Form 16 Part B. Now, please remember, Form 16 must be collated across your employers. If you have moved employments during the year, whether one employer, more than one employer, 2, 3, 4, whatever the number may be, even if you have served in the organization for a mere 15 days or 10 days or even a week, Form 16 will be issued, and you must include the details of all your employment between 1st April 2024 to 31st March 2025. Then if you want to claim house rent allowance under the old tax regime, you will have to have rent receipts handy or rental agreement handy. And wherever the annual rent payment exceeds rupees 1 lakh, you will also require the PAN of the landlord. Then bank statements on interest on savings account, interest statement, fixed deposits. Now this is not compulsory, however recommended, so that you're able to cross-check your interest income along with the AIS. In case the AIS is not updated, then these statements may be relied upon to ascertain the exact interest income you have earned. Then any TDS certificates that may have been issued by the banks, interest certificate issued by the bank, sale and purchase deed. If you have gone ahead and made a sale of property, or you have gone ahead and sold any other capital asset which has to be assessed to capital gains, in that case, whatever are the corresponding sale and purchase deeds, those are important. Form 26AS and TIS or AIS. Now these documents, 26AS, AIS and TIS, can be easily downloaded by logging into your IT portal. There are separate columns, there are separate fields for each of these items. You can click, select the relevant assessment here and download the PDF file. Then if you have to go ahead and make a claim for any deduction or exemption, you will require the corresponding investment proofs for all such deductions and exemptions. Now let us understand the additional compliance requirement under the old tax regime. So earlier in the poll, we asked that if you're aware of how the ITD is making the claim of deductions and exemptions fully transparent. We will now understand how the claim is being made fully transparent and what is the impact that will have on the users. So if you're a user under the old tax regime and want to claim house rent allowance, this year onwards, you will have to go ahead and declare the total rent paid, the place of work, your basic salary, all these details to go ahead and compute the HRA exemption. So in the ITR form itself, in the utility, what the IT department has done is they have introduced additional fields asking for these details. And once you go ahead and input these details, the HRA exemption will be automatically computed. Now, if you wonder that I have submitted all these documents to my employer and Form 16 rightly captures my HRA exemption, do I still have to go ahead and do this? Absolutely, yes. Even if your Form 16 is reflecting these deductions, you will still have to give a detailed breakdown or the documents or the details required in the ITR form. Now talking about 80C investments, whether you're investing in fixed deposits, insurance, Sukanya Samriddhi scheme, or any other relevant and applicable deduction under Section 80C, you will have to go ahead and provide the unique documentation identification number where you have invested in life insurance policy or term insurance policy. You will also have to give the policy number. This is mandatory. If you do not submit this document identification number or policy number, the ITR will not factor in your 80C deduction claim. Similarly, if you want to make a claim for medical insurance, you will have to go ahead and give details of the name of the insurer, the policy number. So this policy number is unique policy number to each of the policy holders. So this policy number will have to be entered. If you have taken an education loan or a housing loan, in this case, the requirement is a lot more detailed, in the sense that you will have to submit your bank account details, loan account number, date of sanction of loan, the loan amount, outstanding balances. All these details will have to be submitted. Now, please note that these details will be available in the loan certificate issued by the bank. So once you get the loan certificate, these details will automatically be there. With respect to the balance, the outstanding balance, you can go ahead and refer to the respective loan account as of 31st March 2025, and whatever is the balance, the same amount can be entered. In case you're going ahead and claiming any other specified deduction under ATDD, ATDDB, or ATU, these are for specified diseases. In this case, you will have to also specify the name of the specified disease, the member of the family who is suffering from the disease, your relationship with them, and also acknowledgement number of 10IA. Now, 10IA is the form that has to be mandatorily submitted if you want to go ahead and claim a deduction under any of these deductions. That is ATDD, DDB, and ATU. These are for treatment of specified diseases such as cancer, leukemia, etc., or in the case of specified disability, locomotor disability, low vision, etc. Now let us go ahead and do a deep dive and understand what are all the ITR forms for assessment year 25-26. First and foremost, we have ITR1. ITR1 is the simplest form. It includes income from salary up to rupees 50 lakhs, income from pension, income from one house property, income from other sources. The key change introduced in the ITR form for this year, that is assessment year 25-26, is that if you are an assessee who has long-term capital gains up to rupees 1.5 lakhs from shares or equity-oriented mutual funds, in such case, you will be eligible to file ITR1. Please note that only long-term capital gain users can file ITR1. If you have short-term capital gains or short-term capital loss or long-term capital loss to be carried forward, in such case, you will not be able to file ITR1. ITR1 is exclusively for gains. And please remember, ITR1 is where your income is less than 50 lakhs, your aggregated income. And ITR1 does not support reporting of foreign assets, foreign income. If you have any foreign shareholding, foreign bank account, or if you have received ESOPs and RSUs from your employer, ITR1 is not the right form for you. Now let us move on and understand what does ITR2 entail. ITR2 is for cases where your total income exceeds rupees 50 lakhs. ITR2 can be filed for all the incomes that we have discussed in ITR1. In addition to that, if your capital gain exceeds rupees 1.25 lakh, or where you have short-term losses or long-term losses to be carried forward, or short-term gains to be reported, you can use ITR2. If you have brought forward losses from the previous year, or if you have current year losses which have to be carried forward to the future years, you can use ITR2. In case you have more than one house property, ITR2 is your form. Income from crypto, foreign income, foreign asset reporting, all of these will be useful in ITR2. The relevant form, if you have any of these income streams, is ITR2. Now let us move on and understand who are the users who can opt for ITR3. Now, ITR3 is predominantly for users having business or professional income. So in case you have any income from business or profession, either for part of the year or for the entire year, ITR3 is the right form for you. In ITR3, you can go ahead and fill all the incomes that we have discussed, which are applicable for ITR2. In addition to that, you can also go ahead and enter your business and professional income and income from partnership firm. Moving on, let us now talk about ITR4. Now, ITR4 is also an ITR for business and profession predominantly. However, the difference between ITR3 and 4 is that While ITR 3 is for your regular businesses, ITR 4 is applicable to those taxpayers who want to go ahead and opt for presumptive taxation. So if you fulfill the criteria for the specified businesses and eligible professions, wherein you can opt for presumptive taxes by going ahead and declaring a certain percentage of your total turnover as your income, that is known as presumptive taxes. If you are eligible to opt for presumptive taxes, you can opt for ITR 4. Under ITR 4, you can enter details of all incomes entered under ITR 1, in addition to business and professional income, which is eligible for presumptive taxation. I hope this is clear. Moving on. Now let us talk about key changes in ITR forms for AY 25-26. With respect to ITR 1 and 4, which are similar in nature in terms of the total incomes that can be entered, ITR 1 and 4 now also gives the taxpayer the flexibility of entering their long-term capital gains income. Please remember, only long-term capital gains up to rupees 1.25 lakhs can be entered in both ITR 1 and 4 from assessment year 25-26 onwards. Please remember, this was not available in the earlier years. In addition to that, in both ITR 1 and 4, now you will have to go ahead and do a detailed reporting of all the deductions and exemptions you want to claim under the old tax regime. So we have just discussed earlier on what are all the key changes, what are all the detailed requirements you have to enter depending upon the deductions you're claiming. So those will have to be entered now in a detailed fashion. Moving on to discuss ITR 2 and 3. In ITR 2 and 3 as well, there is a separate reporting for sale of capital assets before and after 23rd July 2024. Now, this is important because 23rd July is the cutoff period after which the budget changes were implemented. Any capital gains before 23rd July 2024 carry a separate tax rate. For long-term capital gains, the rate was 10%, and for short-term, it was 12.5%. However, after 23rd July, the capital gain, long-term capital gain is 12.5%, and the short-term capital gain is 20%. So this bifurcation is very, very important. And in both ITR 2 and 3, this disclosure, this demarcation has to be clearly maintained. In addition to that, now ITR 2 and 3, asset reporting requirement comes into picture only where the income of the assessee exceeds rupees 1 crore. Earlier, this requirement was restricted or applicable when your income exceeded 50 lakhs. But from the current year onwards, mandatory asset disclosure is required only where your income exceeds more than rupees 1 crore. Now coming to discuss the important points for assessment year 25-26 filing. First and foremost, with respect to tax rates, there are no significant changes under the old tax regime. Whatever were the tax rates, whatever were the requirements in the earlier years, the same continue to be in place for users filing under the old tax regime for assessment year 25-26. However, there have been certain changes under the new tax regime. First and foremost, standard deduction under the new tax regime has increased from rupees 50,000 to 75,000 rupees for all salary taxpayers. Please remember, this increase is only under the new tax regime. Secondly, deduction for employers' contribution to pension under the new tax regime has been increased from 10% to 14% of your basic salary. Under the new regime, this change is effective. Under the old tax regime, employers' contribution towards pension continues to be at 10%. Next, moving on, talking about rationalization of capital gains. Most importantly, the period of holding has now been rationalized to bring it down to a uniform period of 12 or 24 months instead of the earlier periods of 12, 24, and 36 months. So the 36-month period has been completely abolished. Currently, the holding period is only twofold, 12 months and 24 months. Indexation benefit has been completely removed on all asset categories except for land and building purchased before 23rd July 2024. If you have purchased land and building before 23rd July cutoff, in that case, you will continue to have the benefit of indexation. You can either choose the benefit of indexation or the applicable tax rate, whichever is more beneficial. Then long-term capital gains will attract tax rate of 12.5% on or after 23rd July 2024. And the exemption limit has been increased from 1.25 lakh has been increased to 1.25 lakh from rupees 1 lakh. Lastly, short-term capital gain on specified assets has been increased from 15% to 20%. So if you have entered into any short-term capital gain transaction on or after 23rd July 2024, the applicable rate will be 20%. Now let us quickly take a look at tax slabs under different regimes for assessment year 25-26. Under the old regime, income up to 2.5 lakhs is not taxable, which is also known as the basic exemption limit. 2.5 to 5 lakh will be chargeable at the rate of 5%, 5 to 10 lakh at the rate of 20%, and income above 10 lakh at the rate of 30%. Then wherever the total income exceeds rupees 50 lakhs, the applicable rates of surcharge will be 10, 15, 25, and 37%, depending upon the total income exceeding the 50 lakh benchmark, followed by cess at the rate of 4%. Now, if you're a user under the old tax regime, the basic exemption limit changes depending upon your age. If you're a senior citizen, that is a person above the age of 60 years, the basic exemption limit will be rupees 3 lakhs. And where you're a super senior citizen, that is a person above the age of 80 years, the basic exemption limit will be rupees 5 lakhs. Now talking about the new regime. Under the new regime, the basic exemption limit is rupees 3 lakh. Income up to 3 lakh will not be chargeable to tax. Income from 3 to 7 lakh will be chargeable at the rate of 5%, 7 to 10 at the rate of 10%, 10 to 12 lakh at the rate of 15%, 12 to 15 lakh at the rate of 20%, and income above 15 lakh will be chargeable at the rate of 30%. The applicable rates of surcharge wherever the income exceeds rupees 50 lakhs is 10%, 15%, and 25%, followed by cess at the rate of 4%. Please note, under the new tax regime, the basic exemption limit does not differ depending upon the age of the person. Irrespective of the age of the person, the basic exemption limit is freezed at rupees 3 lakhs. So now let us, move ahead to the second leg of the session, wherein we give you a clear tax filing walkthrough, how you can go ahead and file your taxes using the clear tax platform. So currently only ITR 1 and 4 is live on the clear tax portal, as the government has still not issued ERI license for ITR 2 and 3 filing. So if you're an ITR 1 or 4 user, you can go ahead and file your ITRs. If you're an ITR 2 or 3 user, what you could do is you can still go ahead and make all the computations of your income, feed in all the income details, all your other details whichever are relevant, whether it is foreign asset reporting or whether it is Indian asset reporting, capital gains, etc. And once the filing is live, the timeline for which is tentatively 1 week from now, you can go ahead and file the ITR 2s and 3 as well. So first and foremost, what you have to do is you have to log into cleartax.in. Once you log into cleartax.in, you have two options. You can either click on book now if you want to opt for assisted filing, or if you want to do a DIY filing, which is a self-filing, you can click on start now. Once you click on start now, you will be redirected to go ahead and log in. If you're an existing ClearTax user, you can log in. If you're a new user, you will have to register yourself. Once you have registered and logged in, as the case may be, you can click on start filing. Now, start filing is divided into 3 broad processes. First and foremost, you have to go ahead and link PAN and pre-fill your ITR, then add all your details. Lastly, once all the details have been added, the computation has been prepared and vetted by you, you can simply go ahead and file the ITR and verify. Now, link PAN and pre-fill are very, very important because this will help us gather all your data existing on the IT portal against your PAN. So all the data is populated to ensure that the return is accurately prepared, to ensure that all the income streams are accounted for, all the tax deducted at source All right. Some sources which you may also not be aware are correctly accounted for. And this is important. We have seen that there are so instances where users themselves are not aware of the TDS done against their PAN. Now, salary TDS is something we are all aware of, but then there are various other things where tax is deducted. For example, if dividend is paid above a certain threshold, or if we are going ahead and making foreign remittances above a certain threshold, if you have purchased tour package programs above a certain threshold, or if you have purchased a vehicle, all these instances lead to either TDS or TCS deduction. So in this case, pre-fill helps capture all those data correctly. So how a pre-fill is done? Pre-fill is very simple. You will have to go ahead and submit an OTP. Now this OTP can either be Aadhaar based OTP or IT department generated OTP. Once you go ahead and do a link PAN and pre-fill, you will be redirected to upload your Form 16. So here is where you can go ahead and upload all your Form 16s. If you have multiple Form 16s can be uploaded here. If you have a single Form 16, you can upload a single Form 16. In the meanwhile, if you have any quick question or any regular question or most often asked question, we also have a detailed FAQ here. You can go ahead and click on any of these FAQs and get your queries answered. Once you have uploaded your Form 16, you will be redirected to the personal information page. Now, in the personal information page, you will have to enter all your details. However, if you have done the pre-fill in stage 1, all the data will be automatically captured here. You will not have to enter any data unless you want to edit the data. For example, if you want to edit your residential address, or you want to edit your bank details or any other fundamental details, in that case, you can edit. Otherwise, if pre-fill is done, all of this data is automatically populated. Once this is done, then we move on to income source. Now, the income source pages has all the different types of income, you starting from salaried income, then interest income, interest from house property, capital gains, foreign asset reporting, crypto income, and any other income, exempt or not. So all the details will be found here. Depending upon what your income streams are, you can start clicking on add details. Once you do that, it will take you to the respective income card for entering more details required. So for example, if you have clicked on salary, then if you have uploaded the Form 16, the software will automatically parse all your data. In case there are changes to be made to your data, that can be made here. And in case you have to claim any exemption, there's a drop down. You can go ahead and select the relevant details, the relevant drop downs, and enter all the details. Next up, we talk about income from stocks and mutual funds. So if you have income from stock and mutual funds, you can click on add details. Once you click on add details, the page pop-up opens is this, wherein we have a tie-up with a lot of brokers. The broker list is listed here. Whoever is your broker, you can go ahead, click the broker, either do a direct login and import, or if you have already uploaded the documents in stage 1, all right, if you have already uploaded your capital gain statement for the correct period in Excel, the software will automatically parse all the data. In case you want to manually enter any data, or in case where your broker is not listed here or your wealth manager is not listed here, you have two alternatives. You can either download the ClearTax template or you can enter the data manually. If you want to download the ClearTax template, an Excel file will be downloaded onto your system. You can open that file, fill in all the relevant details, and re-upload the file again. Once you upload the file, the data will automatically be captured here. In addition to capital gain reporting, if you have any other reporting that has to be done, whether it is foreign assets, capital gains from ESOPs and RSUs, sale of land and building, bonds and debentures, or any other capital asset, you can go ahead and select the relevant drop downs, the relevant option, and fill in all the details. Next up, gain income from ESOPs and RSUs. This year we have made a dedicated reporting or a dedicated drop down for ESOPs and RSUs. So currently the platform supports fidelity. So if you are a user or if you're an employee whose stockbroker outside of India is Fidelity, in that case, you can go ahead and download the custom transaction summary statement from your Fidelity account. Once you upload the custom transaction summary onto the product here, the data will automatically be passed for the current year. So any dividend details, any sale of ESOPs and RSUs will be captured here. If not, you can also go ahead and manually add all those details. Click here on add details. This is the pop-up that will open. You can go ahead and list down all the details like date of sale, date of exercise, then the amount of sale, the amount of purchase, etc. And then the gains, corresponding gains will be automatically computed. Now, this is how the ESOP data will look. And please note that we do understand that the custom transaction summary statement is in dollars. Please do not worry. The software itself will go ahead and apply the correct conversion rates, which are given under the provisions of the Income Tax Act, and do the conversion in INR. However, if you're entering the details manually or using the ClearTax template, in that case, you will have to ensure that all the data that you're entering is in INR. Next, we talk about income from house property. So if you have a self-occupied property on which you want to go ahead and claim interest on housing loan, you can click here on self-occupied property, enter your address, house address details, enter the details of the owner. If it is a co-owned property or a jointly owned property, please enter the details of the co-owners as well. Then you can go ahead and enter the annual interest paid. Please note that interest on self-occupied property is allowed only under the old tax regime. It is not allowed under the new tax regime. Next, if you have a rental property, that is a property that you have given on rent, you will have to select let out property. In let out property, again, you will have to enter your tenant details, house details, owner details. In addition to that, for a let out property, you can also claim deduction of any municipality taxes paid or any property taxes paid. So if you have paid those taxes, make sure you go ahead and take a deduction of the same. And then you can enter the total income received. In addition to that, if you have any interest on the let out property, you can also enter the interest details. Once you enter all these details, the total income from house property, both self-occupied and rental, will be computed. So once this is done, then you can also go ahead, and if you have any online income or if you have any other residuary income, whether it is interest from saving bank, interest from fixed deposits, or interest from securities, etc., you can go ahead and click on the section exempt online and other income. Once you click on add details here, you can enter all details. Now, please remember, it is pertinent to note that if you have any exempt income, for example, if you have income from PPF accounts, which are tax-free, just because an income is tax-free does not absolve you from the requirement of reporting the income. The income still has to be reported. It has to be reported under the exempt section. So please make sure that you enter all the income details correctly. Moving on, if you have professional business or business income or freelancing income, then you can go ahead and click on professional, freelancing and business income. Whatever is the relevant field applicable to you, you can click on add details, enter all the details here. Next, if you have income from VDA, that is virtual digital assets or crypto income, in that case, again, you can go ahead and click crypto income. Here, once again, we have partnered with several brokers. You have two options. You can either log in and import the data directly, or alternatively, you can manually add the details as well. Once this is done, once you have populated your income sources entirely, then we move on to tax savings. In tax savings, first and foremost, we have tax deduction. You can click on add details, add all the deductions that you want to claim here. Then here, taxes paid, TDS and TS. You can click on this hyperlink, upload for 6AS. Once you click here, you can upload 6AS. Or if you have already uploaded your 26AS initially, then the data will automatically be passed here. Now, please remember, whenever you're filing the return of income, make sure you're using the latest 26AS, AIS and TIS. If you're filing the return of income, say for example, on 25th July, Try to use the AIS 26AS and TIS generated as of 25th July itself. Please do not use data which is a month old or 2 months old. The chances are that the older the data, the more less updated it is. So make sure you use the most relevant, recent and updated data set. Then if you have any carry forward of loss, then you can go ahead and click here, add details, and enter all the data. So tax saving deductions, here is where you enter all the details. And as discussed, if you're under the old tax regime, then there will be a detailed data requirement in terms of the document ID, the policy number, etc. So every time you click on each of these options, a new pop-up will open wherein you can go ahead and enter the document identification numbers. Then if you have any carried forward losses or any such details, here is where you have to enter the data. Next, we move on to taxes paid, TDS and TCS. As mentioned earlier, if you upload Form 26AS, the data will automatically be captured. Once the computation is prepared, if you have made any self-assessment taxes or if you are going to pay any taxes now, once the taxes have been paid, you can click on the first option, add details, and upload the document directly. The moment you upload the document, the software itself will go ahead and parse all the details for you. Then we move on to foreign assets and income reporting. So if you have any foreign assets that you have to report, Schedule FA is the place where you have to go ahead and report all your foreign assets. You will have to report the date of acquisition, the amount of acquisition, and then the company name, then closing balance, peak balance, etc. Now, please remember, whenever you're filling Schedule FA, that is Schedule Foreign Assets, you will have to make sure that all the values are in INR. The INR conversion rate must be used basis the formulae given by the provisions of the Income Tax Act. Then we have Schedule FSI. So if you have any income accruing outside India, that is if you have received any interest or dividend income on your ESOPs or on your foreign investment, Schedule FSI is the place where you have to enter all the details. And if you have paid taxes outside India, you can go ahead and claim a corresponding credit of those taxes paid to avoid double taxation of the income. Now, to do that, while you have to fill Schedule FSI, you will also have to mandatorily fill something known as a Form 67. Form 67 is a mandatory requirement. It has to be filled directly on the income tax portal. Form 67 is the proof of payment of taxes outside India. Only once you file Form 67, you will be eligible to claim a credit of all the taxes that you have paid outside of India. And Form 67 must be filed before you file your ITR. So once all of this is done, we move on to the last tab, which is the tax summary tab. Now in the tax summary tab, you will be able to see all the data pertaining to your final tax computation and the liability thereon. So if you see here, first and foremost, the software will go ahead and select the regime which is more optimal for you, even if you have entered all the data pertaining to old tax regime. That is to say, you have entered all the deductions and exemptions. However, if the software believes that the new regime is more beneficial for you, that is the regime that shall be picked. And then you will also be able to view an AI summary of your calculation, the ITR type. And in case you want to compare or switch to the other regime, there is an option here wherein you can click on compare and switch the regime. You will be able to see a detailed report of the computation under both the regimes. Then once this is done, there is also an option to go ahead and view your detailed tax report. So you click on this hyperlink, view detailed tax report. And once you do that, this is the page that will open up, which will have details of all your income, the tax breakup, any interest payments that are there. And if you have taken any other deduction, all the data will populate here. So you can refer to this computation of income. Once you're done, if you have any tax payable, you can go ahead and pay the tax dues. If you do not have any tax payable, and currently if you're filing ITR 1 and 4, in that case, you simply can go ahead and finish the filing. You click on finish filing, you do the filing. Once you have done the filing comes the most important step, that is to verify your ITR. Now, this is very important. Unless and until you have e-verified your ITR is not deemed to be completely filed. And the time limit to e-verify the ITR is 30 days from the day you file your return of income. But it is highly recommended and encouraged that you go ahead and e-verify your ITR immediately. It is a very small process. All you have to do is once the screen pop-up opens, you have to click on get OTP. You will get an Aadhaar-based OTP. Enter that OTP, submit the OTP, and your e-verification is done. Once your e-verification is done, you will get an acknowledgement stating that a e-verification is done. But before that, since you're a DIY filing user, there will be one step. If you're satisfied with all the computation here, then only then will a payment pop-up open. So here is where, depending upon the ITR, depending upon the case that you fall under, the fee will be generated here, and you can click here, pay the amount, and proceed with the ITR. Once you have done this, there is a self-declaration you have to fill stating that all the details that you have entered are accurate and right to the best of your knowledge. Then ITR filing is successful. You e-verify your ITR. Once your ITR is e-verified, you will get a pop-up, e-verification is successful. So with this, we come to an end of today's presentation. And for all our Pluxee users today, we have an exclusive ITR filing link for you along with exclusive coupons. Click on them, explore the page, explore the kind of options that you have in terms of both assisted filing and self-filing. And if you have any other questions, any doubts, you can reach out to the email IDs mentioned here, or you can also reach out to the number mentioned here. These are our executives, our dedicated relationship managers who will help you with all the doubts you may have. So with this, we've come to an end of today's presentation. Thank you so much for being such a wonderful audience. Now, I do see that there are a lot of questions in the Q&A section. So we will go ahead and take up each of these questions. All right. Question is, how does section 54F work? How to use the same, and what's the key thing to keep in mind? All right, this is a very good question. So section 54F is a section under the provisions of the Income Tax Act, which helps you go ahead and claim an exemption towards the liability arising on account of long-term capital gains. So if you have long-term capital gains, you can go ahead and reinvest the amount of capital gains and claim an exemption. So the reinvestment typically is made in residential house property. So if you go ahead and make an investment in an under construction property or a ready to occupy property, if the entire sale proceeds are invested, there will not be any capital gains tax payable. Now, there are predetermined periods by which you can make the investment. In the instance that you are not able to invest in the house property immediately, or you need time to think through, you have an option to go ahead and deposit the entire value of your sale consideration in a separate account known as the CGAS account. Now, in the CGAS account, this is an account separately opened through your bank. The full amount of sale consideration will be deposited there, and you can continue to use that account only to make future reinvestments, future investment in the subject property. All right, there is a question on what do you mean by full transparency. So earlier years, whenever you claim these deductions, you were not required to go ahead and give any supporting data in terms of document identification number or in terms of minute details. However, this year, if you're a user under the old tax regime, in that case, wherever you're claiming the deductions, you will have to give corresponding document IDs. Now, these document IDs refer to the unique IDs that you will get. For example, if you're investing in PF, EPF, your unique ID will be UAN. So this will ensure full transparency where the IT department can go ahead and validate these numbers, validate these document ID numbers from the respective person or from the respective institution where you have taken the loan or where you have, deposited your investments, whether it is EPF, PPF, NPS, etc. There is one more interesting question. I have been filing ITR1 for all these years. I do not have any realized gains or losses. But this year I got interest from my investment in Cred Mint. Can I still file ITR1 or other ITRs? My understanding is Cred Mint is sort of, an interest that you're getting. Since it's an interest income, you can still go ahead and file ITR1. Whatever is this interest income that you're getting will have to be reported as income from other sources. Then where to share the will you share the presentation with us? Absolutely, yes. The recording of the webinar along with the presentation will be shared. Where to upload the rent agreement? The rent agreement must not be uploaded anywhere. However, it is good to have it handy because the rent agreement will have all the details that you will require to input in your ITR. Is bank statement mandatory for HRA deduction? Absolutely not. Bank statement is not mandatory for exemption. Alternatively, you will require the details, the rent paid, the city you're working in, the place where it is there, and in case where the annual rent paid exceeds rupees 1 lakh, PAN of the landlord becomes mandatory. If you do not give the PAN of your landlord to your employer, the employer will go ahead and reject these claims. All right, next, we don't need to include when we buy any mutual funds. All right, so typically when you purchase any mutual funds, you do not have to declare them unless your income, your total income exceeds rupees 1 crore. If your total income exceeds rupees 1 crore, in that case, mandatory asset reporting requirements kick in. In that case, you will have to disclose all your assets. However, if you only purchase the assets and you're holding them, you have not sold them, you do not have to declare these assets. How will additional premium paid for top-up coverage taken in company's Mediclaim policy be claimed? So typically, if you have taken any policies through your employment or through your organization will themselves make sure that whatever is the top-up premium you're paying or whatever is the additional premium you're paying, it is already factored in your Form 16 deductions. In case of school fees, the document identification number will be the document ID given in the school fee receipt. So every school fee receipt has a unique ID. You will have to take that ID and input it. There is a question, can we take home loan prepayment under Section 80C? Under Section 80C, you get deduction only towards principal. So if your housing loan interest certificate shows that you have gone ahead and paid principal amount, on that basis, we will be considering the value under 80C. And please remember, under 80C, the maximum amount of deduction that you can claim is rupees 1,50,000. Even if your HRA is, even if your rent payment is rupees 8,000 a month, you will still have to disclose the details. However, you may not be required to give the PAN of your landlord. I see that there are several questions on Cred Mint. All right, so the questions are whether any income from Cred Mint is capital gain or not, or whether it qualifies as capital gain or not. So predominantly, Cred Mint is a peer-to-peer lending platform. All right, it is a P2P lending platform. So when it is a P2P lending platform, any interest that you get from there will be categorized as interest as income from other sources. It will not be a capital gain. And if you see earlier on in the screen, we also have a dedicated stream for P2P lending. So if you have any interest income from P2P lending, you can go to the respective P2P tab, click on the details there and enter the value. But please be assured it will not be taxed as capital gains. It will be taxed as income from other sources, interest. There is a very interesting question. If I have house under construction, then can I claim house loan exemption and HRA both? Now, as a thumb rule, HRA and housing loan interest cannot be claimed together if you're residing in the same city. However, if for part of the year you were in a rented premise, for the remaining year you move to your own accommodation, in that case, you can claim HRA and housing loan deduction both. The second scenario wherein you can go ahead and claim deduction on interest is when you are living in a different city. For example, your original city of residence is Delhi. However, for the purposes of employment, you have moved to Bombay. And in Delhi, you have a loan for your house property. In that case, you will be able to claim both self-occupied property interest and HRA exemption for the rent paid for your Mumbai flat. What is the last date for ITR 2? The last date for filing all the ITRs, that is ITR 1, 2, 3, and 4 is 15 September 2025 this year, if you are not eligible for audit. If your case is eligible for tax audit, in that case, the deadline currently is set at 30th September 2025. There is another very interesting question. If an individual stayed outside of India for a short-term assignment, specifically for duration of 1 month, how would their income be treated in this scenario? If this is the first time you have stepped outside of India and it is only for a period of 1 month, which is 30 or 31 days, you will still be considered as a tax resident of India. And if you're a tax resident of India, your global income will be taxable. So all the income you earn from wherever, whether it is from US, UK, Australia, or anywhere else, will all be subject to taxes in India. So from a tax perspective, this will not make any difference. Your income will continue to be assessed to tax in India, and you will be regarded as an Indian tax resident. All right, there are a few questions I see on switching the regimes. Now, switching the regimes, there are two things to keep in mind. First and foremost, if you're an ITR 1 or 2 filer, that is, you only have salaried income or you have limited capital gains income, you can freely switch between the ITRs year after year. Even if you have made a declaration of old regime in your Form 16 or at your employer declaration, but if at the time of filing the return of income, you want to switch to the new regime, you can do so, or vice versa is also possible. However, if you're filing ITR 3 or 4, the choice to switch between regimes is not freely available. You will be able to switch between the regimes only once. You will get a one-time option. After that, what is the regime that you have selected becomes your default regime. If you're an ITR 1 or 2 filer, you can indefinitely switch between the regimes. All right. Another question is, my salary is less than 50 lakhs, but I invest in stocks and have long-term and short-term gain. Which ITR should I use, ITR 1 or 2? For the simple reason that you have short-term gain, you will be eligible to file ITR 2. And irrespective of, even if your income is less than 50 lakhs, let's say your income is 20 lakhs, but if you have short-term gains, you will still have to file an ITR 2. What is the difference between LTCG and long-term gain in ITR 2? LTCG is the shortened form for saying long-term capital gain. So LTCG and long-term gain are the same. All right, a very interesting question, and I would request all the audience members to please hear me out here. There is a question by a user. ITR 2 is not available in the IT portal. Shall I file ITR 1 now and later remodify it to ITR 2? So this is something which is absolutely not recommended at all. Please do not file ITR 1 now and modify later. This is incorrect and neither advisable. What you can do is, if ITR 2 is not available yet, you can still go ahead and prepare your computation and keep it ready. Once ITR 2 is live, you can definitely go ahead and file the ITR 2 then. All right. So when we talk about the 50 lakh limit, the 50 lakh limit is your total taxable income. That is to say, from your gross income, we do all the deduction. We do the deductions we do the standard deduction, the basic exemption limit, any other deductions and exemptions you're eligible to claim. So finally, your net income, that is where we see the 50 lakh classification. If your net income is under 50 lakh, your ITR, you're eligible for ITR 1. If your net income is above 50 lakhs, then ITR 2 and onwards will be eligible. There is another interesting question. House property includes land with no house on it. So if you have taken a land on loan, then you will not be eligible for house property interest deduction. House property interest deduction is available only if you have purchased a house property or it is an under construction property. Is dividend earned tax free? If not, it is considered short term or long term gain. Dividend earned is not tax free. All dividend is taxable. It is taxable as income from other sources and not as capital gains. If you have income or loss from FNO, the applicable ITR for you will be ITR 3. All right, there are a couple of questions on a personal tax loan as well, personal loan. So if you have taken a personal loan interest deduction is not available under any provisions of the Income Tax Act. Only if you have taken a housing loan or an education loan, for such loan, there are deductions under the provisions of the Income Tax Act. If you have more than one house property and your income is less than rupees 50 lakhs, you will still be eligible to file ITR 2. All right. Another question is, I have invested in mutual fund. How to update while filing ITR, STCG and LTCG? Now, please remember that long-term or short-term capital gains come into play only if you have sold the mutual funds or the equity shares. If you have not sold anything, you will not have any gain. The Income Tax Act does not tax you on notional gain. For example, you invested in Jan 2025 and as of March 2025, you're sitting on a gain of 20%. This is just an unrealized gain. So on this unrealized gain, there will not be any tax liability. However, if you sell this in March, then pursuant to sale, whatever is the income, on such income, depending upon the period of holding, it will be charged to tax as either long-term gains or short-term gains. Yes, if you want to claim deduction under Section 80DD, DDB or ATU, you will have to file Form 10IA. Again, there are a lot of questions on ITR filing if you have short-term capital gain. Even if you have a single rupee of short-term capital gain, ITR 1 will not be eligible. You will be eligible to file ITR 2, that is the right ITR. However, if you have only long-term capital gain from equity or shares, equity shares or equity-oriented mutual funds up to 1.25 lakh, you will file ITR 1. In case if you have long-term capital gain of even 1.3 lakhs, no loss, no short-term gains, you will have to file ITR 2, not ITR 1. If you only have dividend income or if you have interest income, you can go ahead and file ITR 1 itself. So there are several questions on going ahead and sharing the presentation, the video recording. Absolutely, yes, we will go ahead and share this presentation along with the video recording. So we have extended time already. We do see that there are still a lot of questions. What we could do is we will go ahead and bring out, we will have another session in the coming weeks. So we will try to incorporate all these questions in our deck itself, so that in the next session, there are lesser questions or lesser repeated questions. So whatever are the most often asked question in today's webinar, we will incorporate them all in a PPT. And we would also invite you to come along with us in the subsequent webinars, which we will be hosting once again in a few weeks. Steffi, I think we are towards the end of the session.
Thanks,
Do you have
Megha.
anything to add?
Yeah. I see the last question here. Is there any discount on ClearText? Yes, Pluxy folks, we do have some discounts which are there on ClearText. I've already shared a link with you guys. Just go through the entire page in whichever ITR you fall into. What is the amount? All that is mentioned in detail. In fact, after the webinar, you'll be redirected to that link. So make sure you see which ITR is which ITR you would want to file, and go ahead with the plan with ClearText. And obviously, Megha has already shared the SPOC details. In case you have any questions, queries, you can reach out to Mohit. You can take a screenshot of this. And Megha, it was really wonderful. I mean, I have worked for a finance firm for a very long time, but these terminologies are still new to me. It's very difficult to understand, but in a layman term, you explained us very well. So thanks to you. And we look forward for the next session, which is in the upcoming month, probably in the 3rd week of August. We'll keep you posted about that. Thank you so much. Have a good day. Bye.
Thank you, everyone.